Welcome to Lupin Limited Quarter 3 FY21-22 earnings conference call. Please note all participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the opening remarks. Should you need assistance during the conference call, please raise your hand from the participants tab on your screen. Please note that this conference is being recorded. I now hand the conference over to Lupin management. Thank you, and over to you.
Thank you. Good evening, friends. It's a pleasure for me to welcome you to this Q3 earnings call. As you would have seen by now, overall another difficult quarter for the company, despite some good developments like the sales growth in the US. However, I do believe that with some sound learnings and substantial strengthening, and a number of optimization initiatives underway, we are going to see much better times in the coming quarters, and we're all looking forward to that, and I'm sure you too are looking forward to that. With that brief introduction, I would now hand you over to our CFO, Mrs. Ramesh Swaminathan, for a detailed analysis. Thank you, and over to you, Ramesh.
Thank you, Dr. Sharma, and good evening, friends. Trust you and your family are keeping good in these troubled times. Revenue for Lupin grew 2% quarter on quarter, driven primarily by US growth of 10.4%, driven by again strong growth of albuterol, where we now have a 20% market share. Year on year, we registered 4.3% growth, driven by majority of our markets. US 9%, the India region 12%, along with India others, which was actually 8%. APAC 17.7%. Gross margins grew 1.7% quarter on quarter, whilst the gross margins is down 0.9% primarily due to increase in the input material cost, sales mix, and higher US sales. Employee cost was down 2% quarter on quarter at 18.2% of net sales, primarily due to the savings realized from the specialty restructuring in the US. This despite providing for additional sales incentives in India linked to performance. Manufacturing and other expenses were higher 18.3% quarter on quarter, primarily due to the one-time charge of about $26 million or 193 crores. We reviewed US provisions and determined that there was a need to further increase the same to properly reflect the impact of some one-time items that we experienced over the last 2 years. That is the unusual high volumes of returns from a 2020 patient-level recall of metformin and slow-moving flu medications at wholesalers' warehouses. Other income was down 53%, primarily due to interest on tax refund earned in quarter 2, and this is obviously not there in quarter 3. EBITDA adjusted for the one-time charge of $26 million or 193 crores was at rupees 564 crores, flat quarter on quarter. The adjusted EBITDA of 13.7% versus 14.1% sequentially. Given the exceptional items taken on the Lupin standalone accounts, the bottom line for the first 9 months comes up negative, warranting a write back to the taxes provided till date. The ETR for the full year for the company should be about 30 to 32%, given the tax being paid in certain geographies despite the lower PBT on a consolidated basis. For the next 2 to 3 quarters, we see margins slowly moving up from the 14% levels. The next couple of quarters, EBITDA improvement will come largely from the optimization efforts, and we have several initiatives in advanced stages, including tight management of FTS, our returns, write-offs, freight charges, and plant idle costs. Some of the near-term drivers of growth are going to be SUPEP, PEG GCSF, trade OPM, and growth in India and other geographies. We see meaningful uptick in H2 FY23, and then in FY24, we see the real growth drivers kicking in with full impact of our inhalations portfolio, injectables portfolio, and biosimilars, which will deliver higher numbers and commensurate gain to the margins, and EBITDA levels to move up to about 20% plus. Friends, you would also be happy to note that we have completed our acquisition of a bolt-on in Australia called Southern Cross. It will further add to the numbers going forward. I'll tell you the full story and other issues, I would open the floor for discussions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask questions may raise your hand from the participants tab on your screen. Participants are requested to use headphone or earphone while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from Anubhav. Please unmute yourself. Yes.
Yeah. Hi, guys. Good evening. This is Anubhav from Credit Suisse. Just one question on the next 2 years. So, for the timing, if you assume that you're not going to launch tiotropium and suprep, and I'm talking about next 2 years, and if I classify the rest of the business as base business, can you just talk about how would the gross margin and the EBITDA margin pan out for this part of the business over the next 2 years?
Ramesh, you want to take it, or you want me to take it?
You could take it first, and I could add, Vinita.
Yeah. So Anubhav, we see, your question is the baseline business versus new product launches. What will it contribute? We expect baseline business margin also to improve over the next couple of quarters. Even if you assume fiscal year 23, just the baseline products, with the optimization efforts that we have already executed, as well as the ones that are on the anvil for implementation, we see the potential of, improving our gross margins, offsetting, some price erosion as well, with the plans that we have.
Just some clarity on that. Where will the gross margin improvement come from? Because if one is regional gross margin improvement, second is product level launches. So we have very good product coming in, but except this tiotropium and suprep, I'm not aware of very high value other product which is helping in. So that's why I was asking that one, your efforts on reducing cost can help the EBITDA margin on the operating leverage side, but where I'm not able to understand where will our gross margin improvement will come from.
Please
go ahead.
There are a couple of things, so even during the course of the year, we have taken some exceptional items, as letting off from sales itself, which includes some parts of returns, and for sure provisioning and the like. And these, as you would recognize, are not something which will actually, occur in the long term, in the future as well. And to that extent, we certainly see a blip up coming up insofar as the gross margins are concerned. In terms of other costs, we have identified several pockets where there have been, where we've invested ahead of the curve in the past, as in capacities in terms of SG&A and the like. And we would like to, over the next few quarters, work on all of that and address it. The meaningful movement up would actually come from those as well. So to that extent, the confidence levels of taking the EBITDA margins up is actually coming from there.
So Ramesh, if I can just add here. So I think the question is on the gross margin line, right? So on the gross margin line, Anubhav, it's the business mix. Right now, obviously the US has grown, India has actually degrown in the relative this. So as that mix, changes again in Q1, Q2, you would see gross margin improving as well. Obviously, there's also a story around operating leverage and the like there. But on the gross margin, I think it'll be primarily driven by the business mix.
Okay. And thanks. Second question is just a clarity on the US. So roughly annualized level of $800 million. Very ballpark number. What percentage of our US revenues will be contributed by partner and AG products? Very rough number will do. I'm just trying to understand why our gross margin is so low. So can I understand all this?
Roughly 20%.
20%. Okay, that's helpful. And just last question on the tiotropium. So can you just indicate where is your application with FDA? When did you reply back to FDA? How long it's been sitting with FDA now, and when you expect approval?
We just sent a CRL response, full response, last quarter, and have a TAD date August of this year.
Okay, thank you. I'll join the queue. Thank you.
Thank you. Next question is from Neha Manpuria.
Yeah, thank you for taking my questions. Ramesh, if I were to just look at operating cost, in this quarter, given that we had one-time impact from restructuring in the last quarter, if I adjust for that, operating costs haven't really changed quarter on quarter, despite, you mentioned optimization efforts that we have taken, and the restructuring in specialty. So, could you give some color on, when we will start seeing that improvement? And, despite the restructuring effort, if we haven't seen it in this quarter, what gives you the confidence of improvement going forward?
This quarter we had, in fact, a higher quantum of R&D, so to the extent that's been, captured out here. Going forward, that bit will not be out there. We also spoke about the fact that, if you speak about manufacturing other expenses, we are looking at, in fact, an NCE spin-off itself. And that we are fairly confident will certainly happen over the next few quarters. That will be the other bit. And of course, as I said, other initiatives that we are really taking.
Ramesh, sorry, just to understand the NCE spin-off, would it be, that would be an R&D saving largely, right? Besides that, would it materially change our EBITDA margin besides the R&D savings?
There would be so we are spending close to between 150 to 200 crores on NCE. So if, when the spin-off actions, that would actually be off at least a bit there.
Okay, understood. And second, on the US business, from the current $800 million base, given the price erosion that we are seeing in the launch pipeline, from a 2 to 3 year perspective, what is your comfort on what this number could, look like based on the pipeline that we have, especially since you're mentioning a very large inflection in FY24. And also, just to follow up on that, on biosimilar, besides PEG-DCF, if you could just give an update on our second biosimilar.
Ranibizumab.
Yeah. Yeah. So, in terms of, the new product launch, really second half of next year, as we mentioned, Suprep, tiotropium, and hopefully pegfilgrastim as well. And partial year impact, obviously, in fiscal year 23. But a full year impact we see in fiscal year 24, which gives us the confidence of really growing the US revenues in a material manner. And the commensurate increase in gross margins and contribution to EBITDA margins as well.
On ranibizumab, yeah, go ahead.
I was saying that, yes, on the biosimilars front, of course, pegfilgrastim is our lead into the US market. Etanercept is growing. Mylan is launching in, has a launch plan across all of the different geographies. Most recently, they launched in France. And ranibizumab is progressing. The clinical trials, phase 3 trial in India is progressing well. There were some delays from a COVID perspective, but we're still making progress on that trial. We
and
also have.
When would be the filing for this, likely filing for ranibizumab?
In the upcoming fiscal.
Yeah, fiscal 23.
Sorry, Vinita, I cut you. Sorry. Please go ahead.
23. I'm saying the same thing. Yeah.
In the upcoming fiscal.
Got it. Thank you so much.
Thank you. Next question is from Surya Patra.
Yeah, thank you. Thank you for taking my question, ma'am. So the first, if you can tell me what is the kind of a progress that we are witnessing in case of Fostair in Europe?
Sure, Surya. We've had really good progress in terms of contracting with the physicians, the CCGs that are important to drive utilization of the product. We have seen some uptake, but not to the level that we had expected due to the COVID surge, the Omicron surge in UK. Majority of the CCGs are focused on treating COVID at this point. So we expect the utilization to ramp up over the quarters to come, especially now that Also, UK has opened up quite a bit and relaxed their restrictions quite a bit as well. But we've had really good success in contracting, both with the writers, the physicians, as well as the retailers.
Okay, based on the contracting, is there, and can you share what are the kind of market share now practically that you are witnessing for that, let's say over next 12-month period?
I wouldn't be able to, maybe we can get that to you offline. Okay,
sure. Now my second question is on the margins again, ma'am. Practically, see this, we have seen a kind of a good ramp up in the albuterol. Obviously, some contribution would be coming from the even Foster and all. So despite that, the margin scenario remains really weak, and we are possibly guiding again a lower margin. So this is the third time that consecutively that we are indicating a lower margin scenario. So from the 17-18% level, we have brought down to 16% for H2, and now 14%, that kind of a number that we are indicating. So what is that is really driving down? Whether the pricing scenario, what we have agreed for albuterol, that is much lower what we have been anticipating. And if these are the products are not contributing to the overall profitable growth, then we should ideally be witnessing or waiting only for the Spiriva to really contribute.
Yeah. So actually, to your point, albuterol is actually contributing very nicely to growth in revenues as well as in margin. Offsetting actually a lot of the other price erosions that one is witnessing, which is part of the baseline business. We had actually expected even higher revenues, both in the US as well as in the API business, which suffered due to the seasonal products. So when you look at the seasonal products, Tamiflu as well as the cephalosporins, we were expecting, at least some flu season, like, but haven't seen any whatsoever. It's been, because of protection, people are masking up, which is protecting, but it's also having an impact on the flu season and flu products. So that's why, from a business perspective, revenue perspective, we would have been even higher in the US if we had the flu season as we were anticipating in this past couple of months.
Okay. Just last question, ma'am, on let's say slightly futuristic. See, given the kind of a pricing erosion scenario that we are witnessing in US, which is the largest market, which has been the largest market for us. So, are you really bothered about it that means the overall growth for the business would be impacted by the larger business which is facing challenges? And let's say 3 years down the line, what share of revenue that you will be really looking from US, or your effort from the other market, non-US market, would be rising significantly and possibly would be supporting the overall growth for you?
Yeah, so, thank you for the question, because I think when you start looking at it from a 3-year perspective, one can also take a look at all of the results of the efforts that we have put in over the last many years. And on the one hand, while we're going through, the inflection from the simpler generics to complex generics right now with albuterol and our inhalation portfolio, and seeing the business kind of stabilize right now, we would like to be able to deliver a higher level of revenues and margin growth. But just given that we have just albuterol and Brovana and small Foster is still not, a contributor. But as we see this transitioning over the next couple of years, as we see, the full impact of our inhalation pipeline, as we see the full impact of we haven't seen much impact of our injectables portfolio, but have really great filings at this point with products like glucagon, ganirelix, and the like, and more coming. And products like pegfilgrastim that we hope to launch in fiscal year 23 and have a full year impact on fiscal year 24. I would not be, as an organization, we are not nervous about increasing the U.S. revenues. I mean, we have the potential of growing in the U.S., outpacing other markets, and with products that are going to be more profitable than our baseline products. Already we are seeing that the albuterol margins are, inhalation product margins are higher than obviously the oral solid margins. And as that component of the business changes and revenues grow, we should be able to grow both the company top line with a contribution of the U.S. as well as, margins. I'd say that the revenue mix should roughly be the same. There shouldn't be a material shift. We have, very solid growth, double-digit growth in India on a consistent basis. We expect to continue that in the years to come, and the U.S., will start with in the next fiscal year half-year impact. So a lower growth level, but a higher growth level in fiscal year 24 and 25. But roughly the same level, same mix of the major businesses. The other businesses also, the other markets, we are working on growing scale and operating leverage, in the most prudent manner. So, but they are smaller at this point relative to the US and India.
Sure. Yeah. Thank you. Wish you all the best.
Yeah. Thank you.
Thank you. Next question is from Vishal Manchanda.
Thanks for taking my question. On gross margin, can you break it up as to what is raw material inflation impact and what is the business mix impact?
Yeah. So, the overall impact is essentially, you could say about a half a percentage point is essentially because of inflation. And the balance is essentially because of the sales mix itself.
Yeah. Another 0.3% is the sales mix.
Yeah.
Okay. And on the R&D NCE spend, 150 to 200 crores is the quarterly number. Is that right?
That's the annual number.
That's the annual number. Okay. And just one final question. In India, what percentage of revenue would be from in-licensed innovator brands?
About 15 to 16%.
Got it. Thank you.
Thank you. Next question is from Pratik Kothari.
Hi, thank you for the opportunity. Ma'am, a couple of questions on the US. One, on the base, are we still seeing those high single-digit pricing pressure? And second, our expectation was once we cross this $200 million there, we should see some massive operating leverage come in, but we haven't seen that. So just your comments on the same.
Yeah, so the pricing pressure is here to stay. It's become part of life in the generic business. And we really see it changing materially when the business transitions more towards complex generics. The oral solids, unfortunately, have too many competitors. So one has to constantly be working on trying to gain share wherever it's logical to gain share and reducing cost on older products while growing the business with new products. What was the second part of your question?
Second was once we cross this $200 million of quarterly revenue, we should see some massive operating leverage in the US, but we haven't seen that. So your comments on the same. Yeah.
So I think the operating leverage is going to come from some of the efforts that we have underway that we are talking about. We have, from optimization standpoint, worked on multiple areas so far. On the right sizing the US team, as well as looking at any other areas of revenue or profit leakage, whether it's FTS or returns and write-offs. A big part of operating leverage is also going to come from our plants, which, right now, due to all of the challenges that we've had in the last couple of years, with OAIs and the fact that a new product launches have struggled. We see that the idle cost in the plants have gone up significantly, and has really burdened the P&L quite a bit. But with the efforts that we have underway, on the optimization and idle cost, as well as continued increase in volumes from the products that, now with Goa having cleared the FDA this last quarter, we expect 7 launches out of Goa. Not big launches, not like Suprep and Spiriva, but still contributing to revenues and reducing our idle cost on top of our optimization efforts on plant overheads and idle cost. So you're going to see more of that operating leverage coming, both from the optimization efforts as well as continued increase in volumes with new product launches.
Fair enough. And given that we are pushing our 20% plus EBITDA margin guidance by another year, so where do we stand when it comes to FY23?
So FY23, we see, like Ramesh mentioned, in the next couple of quarters, really more of a margin contribution out of optimization efforts. It's really second half of the year where we have Suprep, tiotropium, and hopefully pegfilgrastim, FDA inspection permitting, coming in that will allow us to ramp it up.
Thank you and all the best.
Thank you.
Thank you. Anyone who wishes to ask question may raise your hand from the participants tab on your screen. Next question is from Kunal.
Hi, good evening, and thanks for taking my questions. Vinita, when you say you have 20 exclusive FTFs, can you provide a bit more color on how the launches are spaced out? And are any of these currently being held back because of regulatory issues at your plant?
I'll take the second question. Yes, some are being held back, but we are actively tech transferring them into other sites so that we risk mitigate there to be able to unleash them in time. They are spaced out actually. If you start looking at fiscal year 23, you have 2 big ones, both tiotropium as well as Suprep, where we exclusive first to file, and then in the years to come, those are the 2 big that come to mind in the next fiscal year. We have other products like tolvaptan, that's a material oral solid first to file. It's out. I think it's fiscal year 25, not 24. So it is spread out over the next fiscal year 23, 24, 25.
Sure. So all these 20 will be in the next 3 or 4 years?
No. I wouldn't say that. We can try to get you the actual spread over, the next 3 years, the next 5 years and beyond.
Oh, that will be great. Secondly, Vinita, actually, you had mentioned, I think you submitted Dulera, I think almost 18 months back. Could you share where you are on this product now? Because I think you had mentioned a FY22 launch earlier. So are you sort of still confident of that launch?
No, not FY22, obviously, because, we're finishing FY22. We've had a CRL. We received a CRL from the agency that was fairly intense. We have put together a response which is going, I believe, in the next couple of months, and hope that we can get approval in the next fiscal year. But it's going to, we are going to wait to see how the agency responds to our CRL response.
Right. And any kind of, what kind of competitive intensity do you see when you eventually launch the product?
So far, we haven't seen any material competitive, actions. We haven't seen, PD studies or alternate studies that we track. So we still think that it's a very nice niche product for North America.
Sure. And just one more. Are you close to settling on Revlimid?
We settled. We settled.
Oh, you have already settled. Okay.
Yeah.
So can we expect a sort of a Q4 FY23 kind of a launch?
No, we wouldn't. We actually saw a lot of risk there.
Right. Okay. Thank you very much for answering my question and all the best.
Okay.
Thank you. Next question is from Anubhav Agarwal.
Yeah, hi. 2-3 questions. First, on the India business, any material move planned by you guys to boost growth in the India business, for example, increasing sales force or looking to aggressively develop some new therapies? Because if US is, it is what it is, right? So I'm just trying to say that what are we trying to de-risk our business and grow the most predictable part of the business?
Sure. I can take that. First of all, I do want to say this on the US. So I think while we need a little bit of a breather, we feel pretty good about some of the growth drivers that we're putting in place in the US. And, while we're over the 200 million number right now, that's coming from, some of it is coming from these partnered products and the like. Obviously, the margin profile there is different from our own portfolio. So as the inline portfolio picks up, as the CEFs pick up, as more of, Goa and other products come to market, that, I would expect that the US margin profile would improve. On India, I think that's our second biggest market. Obviously a market we bank on, a market which we're in number 6. Obviously there is significant headroom to grow. Anubhav, our focus has been on the chronic side. The market is, 2/3 acute, 1/3 chronic. We're the opposite by design. And we have 2 therapies over 1,000 crores. We have another therapy over 500 crores. So much headroom to grow. On the chronic side, we're number 4, while overall we're number 6. We opened up 1 new division last year. There is a programmed, few hundred representatives that we'll keep adding each year. So next will be an additional respiratory division and other divisions as well. I think we're still under indexed in multiple therapy areas like, dermatology, for example, or even in the CNS space, there is room to grow. So lots of room to grow. As you know, I think we're starting a little bit on acquisitions in India as well. So we talked about Anglo-French. Obviously we hope to close that soon. So a lot of headroom to grow, and we're obviously pushing to grow. We're also exploring, as you know, adjacencies like diagnostics. Early days right now, but I would say that I think on the US complex generics, that's where we press the accelerator. On optimization, we press the accelerator as well, and on India region, we obviously press the accelerator as well. So all 3 are going strong.
That's very comprehensive answer. Thanks, Nilesh, for that. Just a couple of more clarities on the US business. One, on the injectable portfolio, how many filings have we already made so far?
I believe we have made 10 filings, Nilesh.
Yeah, I think it was 7 or 8, but yeah, thereabouts. But I think we're also on track to file 6 odd products from India, which are, I would say, about medium complexity kind of products. And hopefully we'll file the first of our Nanomi products in the upcoming fiscal as well.
Yeah.
So without those long-acting injectables, for example, if we just keep them out, the other injectables, how, let's say if we take a period of 3-4 years, how big this portfolio you think on a conservative basis it can become?
So at least 6 plus products filing every year. And I think the first product that we launch will be, the products that will come out of that, products like glucagon, products like liraglutide and the like. So that's why I said medium complexity. I think these will all be great products from us from a launch perspective.
Okay. And on generic version of restasis, I think you guys were working on some years back. Have you been able to file the reformulated version, or you there in this opportunity or not?
No, we've not got approval for the product as of yet.
But are you following that actively?
We are.
Okay. And Ramesh, just a couple of clarities. The other operating income was pretty high this quarter as well. So the usual run rate is about 35 crore a quarter. You're doing about 74, 75. What is the level that we should assume in next 2-3 quarters?
That's essentially coming in from settlements. So to that extent, if it is sporadic in that sense, it's difficult to actually predict it. No?
But should we keep building the base as 35 crore?
Yeah, that for sure.
And for the next quarter, will there be extra pressure from the increase in raw material cost in the quarter 4?
There has been considerable pressure in recent times, as you would recognize across industries and for sure this sector as well. So you could build in a 0.5 percentage point at least.
And so would quarter 4 margin there could be lower than what we had, or your other savings could largely nullify that?
In the vicinity of where we are today, I would say.
Okay. Thank you, guys.
Thank you. Next question is from Sameer Besiwala.
Hi, good evening, everyone. Just a quick question on the margins. If I'm not wrong, in the previous quarter, you had guided for 17 to 18% EBITDA margin for second half fiscal 22. So why does, what has changed within a quarter, 2-3 months, that, our expectations come down so much?
Yeah, Sameer, I'll take the question. So we had indeed said that the second half would be better than the first half, and we could look at around 16%. Sequentially, US has indeed improved, but we had higher than expected competition in famotidine, lower sales in Blumetza than expected and the like. We are also expecting some flu season, which would have resulted in higher sales of Siltamavir. That's not the case. There's a change in business, lower sales in India and which has impacted, and of course the inflationary pressure, which has actually come in. For those reasons, there has been some impact.
Sure. Just a very broad question. Most of the companies your size in the sector have margins anywhere from 20 to 25 or maybe even higher %. And we have been, sub 15% for pretty long now. Is there something structurally, that is out of place, that we are not able to, get it back, even to 18-20%, and it's a big effort. Your sales mix is pretty much same as others. So I'm just wondering, what's that impediment to, get the margins to more normalized levels?
Sameer, I kind of said that, right? I said, there are some inefficiencies that have crept up the system over time. We have also invested ahead of the curve in terms of at least capacities, leading to quite some idle time, and the like. Inefficiencies in the form of FTS for sure. We also had issues in terms of returns. Then of course, freight, air freighting and stuff like that. All of these things that we are addressing, especially when it comes to manpower, it's not an easy question to solve. It could take time. And that's one of the reasons why we said for the next couple of quarters, next 3 quarters, you could expect lackluster results. And things would certainly look up after towards the 3rd or 4th quarter of next year.
If I can add to that, Sameer, structurally, what is different is I think our investment on the R&D front is higher than our peers. I think we have invested in more platforms that have yet to deliver. Whether it is, inhalation has started to, injectables has yet to, biosimilars has yet to in the material manner. Specialty, obviously, we optimized. NCE, we want to spin out, but right now the number is within our R&D spend. So I'd say higher R&D spend, and as Ramesh said, also higher investments in facilities, some of which, again, for, these products for the future, but some, idle cost that has gathered over time that, due to new product launches, not happening due to our OAI, warning letter status. So that portion we are correcting, of course, but as we continue to really launch our products from the new platforms and our optimization efforts, when we look at fiscal year 24 example, when we have albuterol, tiotropium, pegfilgrastim, few products, not just one or two, but 3, 4 products, 5 products on the complex front in the market, we really see both, from a revenue and gross margin pricing standpoint, that upside, as well as capacity utilization standpoint, operating leverage.
Yeah, thanks for this, Vinita. Just a couple of product-related questions. So one is on tiotropium. So for our, comparable device, HandiHaler, what do you think is the addressable market, the net brand sales? Is it like roughly 800 million?
Yeah, close to $1 billion.
Okay. And if you are the only generic there, what sort of a market share expectation is, any range? Is it 20-30? Is it 50-60? If you can help with that.
So maybe our typical market share in products where we are semi-exclusive along with the AG is 50% at least.
Okay, great. And the second question is on Revlimid. So are you saying that it's not going to happen in fiscal 23? It's beyond that, is it?
That's right. We saw risk in launching a limited quantity authorized generic.
So sorry?
We saw risk in a potential launch in the near term.
Okay. So is it like middle of fiscal 24 something, or?
I think it's fiscal year 25.
Okay. Got it. Yeah. Thank you so much.
Thank you. Next question is from Mr. Prakash. Please unmute yourself and ask your question.
Yeah, hi. Am I audible?
Yes.
Yeah, hi, good evening. Question to Nilesh for the Goa plant. So congrats on clearing it finally. But what is our learning there? A, B, what is our discussion for the Pithampur and the other facilities which are still having, because Goa also had out of specification issues, and you had similar issues on the other plant. So what is the dialogue which is on, and when do we expect the next level of inspections for other facilities?
Thank you for that question, Prakash. So we obviously feel very good about the change in status of the Goa site. I think our warning letter was started with Goa, so it's only fair that they should stop. They should end with Goa heralding that. I think you're absolutely right. I think the issues that were in Goa were similar to what has been cited in the past as well. And I think I'm very glad that the agency seems to have noted the steps that we've taken, and I don't think we're done with that. I think they see that we're clearly on the right path, especially as far as investigations are concerned. And that is the same system that they would see at any of our other sites as well. Obviously, each inspection is different. It's a different set of investigators who would come. We already know that it's not going to be remote audits. So I think Omicron has played a little bit of spoilsport on the inspections. So I think it's possibly a few months before which you can expect predictably inspections starting again. But we're ready as far as Pithampur is concerned, or Tarapur is concerned. We're ready. It's the same system in those. Obviously, we remediated on the other items that were highlighted in the past. So I feel much more confident. The confidence that I get from our team is much more. I think our team needed a win. Clearly, Goa points that we're moving in the right direction, and now we would want to get even better at things like investigations than what we already are. So I think we're moving in the right direction. We have a stated goal in the next 18 months to clear all our sites. And I hope that we're going to be able to deliver on that.
Okay. And from your journey from today to, the 20% margin that you're talking about, so where you have built in this in terms of, resolution of your larger facilities with them? I mean, 18 months is a pretty long time, right?
So I think the one good thing is that the real growth drivers, they've all been protected. They've all been inspected separately, and all those inspections have gone through fine. So if you see inhalation, for example, or even smaller platforms like derm, for example, biosimilars, of course, still needs to get inspected as does injectables. But these problems that we had on the oral solids at sites like Pithampur Unit 2 or Goa, or even on API and in a place like Tarapur, didn't translate into disrupting that kind of growth. So I think the bigger products are protected anyway, and it's a question of time to be able to deliver them. Like Vinita said, Suprep will be sooner, tiotropium will be a little later, but it's all coming together in H2. You do see that increase happening. There's some 20 odd products that will get launched from Goa over time. About 7 or 10 of them are ones which were really stuck only for site related issues. The others have some more things as well. So those will come. Like Vinita said, they're not going to be the big products, but I think it's it's those couple of $1 million that you get from each of these products that helps grow the business. We've had a pitiful launch story, and I think that's really vitiated the nature of the generic business in the US, and I think it's high time that we get that back on track. The backlog in Pithampur Unit 2 is even more than what Goa had, so we're looking forward to that clearing and then starting getting more approvals from there as well.
Okay, thanks for the elaborate answer. My second question is on your thought process on rebuilding the specialty portfolio. So currently we are on a thin margin this thing. So what are we thinking about investing for the next phase of building specialty in the US?
So a couple of areas that we're looking at. One, we have really de-risked our P&L for the women's health, right, from a commercial perspective, and have partnered Solosec with a really good women's health company, Exceltis, that has 120 people sales force. That's what we had at peak when in the first year Solosec was tracking at $10+ million in revenue. So we are very hopeful that with the kind of strength that they bring to Solosec, we'll be able to do justice to the product and build a decent level of revenues and profitability, obviously to be shared with them for the fact that they are putting the promotional effort behind it. So one is that on the commercial front. Second, we have built capabilities on the R&D front, on the technology front in IUDs and implants and rings, and have 3 products in development right now that we'll continue to pursue. They'll take time because each of them, the devices and the drug device combinations, implants, rings, require clinical studies. So it takes a little bit of time. It'll take 2 years. But we see the potential of getting these products to market, within a 4-year time frame. So that is one on the women's health front. Second, we are looking at our other platforms. We have our neurology product, Nemuscula, in Europe. We're looking at the potential of bringing it into the US market. Third, looking at respiratory, which has now become the largest part of our business in the US with albuterol and Brovana, to look at areas of unmet need where we can bring in our own products from organic R&D standpoint. And fourth, on the injectable front, where there is a a tremendous opportunity, and that companies like Eagle and others have capitalized with the capabilities that we have now developed around injectables and peptides, iron colloids, and long-acting injectables. We expect to bring in some innovative products. In fact, we have partnered with a company on NDA for phosphonatoin, which is going to be our first 505(b)(2) injectable product. We expect to launch not in fiscal year 23. I think it will be tech transferring in fiscal year 23, but in fiscal year 24. So we're looking at multiple areas, and we'll continue to be both opportunistic as well as proactive in evolving a pipeline.
Perfect. And with your permission, one clarification. So I mean, all the questions are routing through the gross margin thing and the guidance of EBITDA margin of 16%. So the reasons you gave on lower Glumetza, lower flu, etc., famotidine and stuff. So these were all known variables. So what has really changed going down 200 basis point? If you could help us understand that.
Yeah, so the material variable really were the flu products, as I mentioned, not as much, and then we were expecting a reasonable flu season, which we haven't seen any, and also the increase in input cost materials. That has been, the pressure has been higher than we expected.
Okay, lovely. Thank you and all the best.
Thank you.
Thank you. Next question is from Aditya Khemka.
Yeah, hi. Thanks for the opportunity. Any timelines you guys would like to share on the spin-off of the innovation R&D business? And would the structure be that every shareholder of Lupin will get one share of the innovation entity, as we have seen with some of your other companies?
Yeah, so we are actively working on it right now, hopefully in the next couple of quarters. When we are in active dialogue with firms to see, how we can bring in third-party investors into the entity. Right now, it is 100% subsidiary of Lupin, so full value, and the full is within Lupin. And our plan would be to continue to maintain, Lupin shareholding into the entity. So we don't expect to split it off. Ramesh, correct me if I'm mistaken.
That's true.
The value to our shareholders is really going to be through Lupin and Lupin's shareholding in the entity.
Got it. That helps. Secondly, on the capex side, so since we have a lot of spare capacity and we are lacking product approvals, what is it that we are incrementally spending the capex on, and what is our capex budget for 22 and 23 fiscals?
A chunk of it actually going to maintenance, and of course, there is of course something to be built for biosimilars, as and when they improve, and essentially that really, not too many, new capacities being built at this stage.
And the budget, Ramesh, for FY22 and 23?
It would be in the ballpark of 500-600 crores max, everything put together.
Got it. And I missed maybe if you talked about the India acquisition and your recent foray into diagnostics. So Nilesh would love to hear your view on what is the quantum of sales have we acquired, how much have we acquired it for, what is the kind of synergy you expect, and if you can talk about the diagnostic foray as well. Thank you.
Sure. So Anglo-French roughly about 95 crores sales. I think we talked about the fact that it's approximately 325 crores. Cost, it'll be accretive from day one. Basically, it's two big products that really helps us build in the vitamins, minerals, supplement segment, B-Plex, and another product, Nitrovet. In the VMS segment, it'll take us from number 18 to number 11. So obviously a nice move. And we're hoping that by March we should be able to close it. Diagnostics, I think early days to talk. We just launched the business in December. We've got 3 or 4 labs right now, another 3 or 4 labs that we're managing. Q4, we'll see a major ramp up. We'll see another 8 labs coming up. There are already, a couple of 100 collection centers up. I think the next year will be the defining year for that business. We're seeing nice traction at this point of time, but very small in the Lupin scheme of things. I think 12 months from now will be a great time to talk more about diagnostics.
Yeah, okay. Thank you.
Thank you. We will have last 2 questions. Next question is from Tushar Manudhane. Yes, Tushar, go ahead.
Maybe go to the next one. We can
Okay.
go back to
Next question is from Krishnendu Saha. Krishnendu, if you can just unmute yourself and ask your question.
Yes. Can you hear me?
Yes. Please go.
Yeah, just on the diagnostic business, does your margin improvement take into account all the expenses which you will incur for the diagnostic business? And just curious to know, when do you think your Goa plant will start getting approval because of VAI? So when do you think that? And the third question is, how much the idle cost is being saved if things come into place with time? So
sure. Yeah.
A couple of more questions, but we run out of time nonetheless. If you can give me these numbers.
Sure. Your first question was on
how much expenses of the?
So yes, we have taken it. We've taken the diagnostic business spend in the overall India region plan as well, and we still expect to deliver on the EBITDA improvement. The burn is not that high. There will be a burn increase, but there will be more than commensurate increase in the India region profitability that would happen anyway. On Goa, we already had 1 approval, as you know, and that product is getting launched shortly. There's another 6-7 products that we would expect to get approved in the upcoming fiscal, and those will get launched as well. And then there are, I think there's approximately about 20 products that are still pending from Goa. On the idle cost, I think as we pick up, I think the idle cost is, first of all, idle cost is never going to be zero. It's obviously going to be, it needs to be optimized. I think what has happened right now is demand is significantly down for multiple product categories, the CEFs, for example, both API and finished products, for some of the other products as well. And I think that is accentuating the idle cost right now. Obviously, the other part is some of the capacities that we've created for new growth drivers, which are not kicked in. So injectables, for example, which is still not inspected, biotech, where it's still not adequately utilized. So those would add to the idle cost as well. And part of our optimization is going to be, increase in revenues of some products to optimally utilize our capacities. But the other is actually going to be, workforce planning around some of the plants as well, where we don't see a meaningful uptick over time. And that is something that we're expecting to close in the next 3 to 4 months, after which you'll start seeing benefits of that.
Sure. But is there any number you can share with us? And would you in the future, would you be separating the diagnostic business numbers and the pharma numbers separately?
Yeah. So even now, the diagnostic business number is reported separately because it is a wholly owned subsidiary of Lupin. We will be calling it out.
Sure.
Okay.
Yeah. Thanks.
Thank you. The last question is from Vishal Manchanda. Yes, Vishal, please unmute yourself and ask your question. Okay. I think Vishal is not here. I now hand.
I think Tushar has a question as well. You can take that.
Yeah. Yes. Tushar, you can ask your question. Am
I audible now?
Yeah.
Yes, go ahead.
Yeah, thanks for the opportunity. So, there's some bit tabled with respect to these surprise inspections. I mean, all inspections going in a surprise way rather than scheduled. Do you see this as a risk? And if so, then how are we able to mitigate?
So I think that's a stated intent. That's in that bill. We'll see what happens on that count. In any case, pre-COVID, there was really no notice period that was given other than for PAI kind of inspections for new facilities, regular surveillance inspections for a while. Although it was a pilot in India, but I think for a while regular surveillance inspections were happening. I don't think it makes a difference whether you two-day notice period or no notice period or a 1 month notice period. There isn't much that you can do because everything is data, everything is records which are available now.
Secondly, on this API business, we have seen good amount of deceleration now for 4 quarters. So, any specific structurally things not going our way, or how do we look at the sales run rate going forward?
So I think the API business has been very challenged at this point of time with the lack of demand in cephalosporins, coupled with the increase in PNG prices. There's margin pressure, but really there is no demand for cephalosporins at this point of time. We obviously see that normalizing, and with that will come meaningful increase in API sales as well. Right now, my feeling is that is really Q2 and beyond. I don't think we see it in the next 3-4 months as a meaningful uptick.
Got you, sir. And just lastly on other expenses excluding R&D, while we have been working on the cost optimization measures, but on an absolute basis, other expenses excluding R&D and employee cost still continue to rise. Even sequentially, it's higher at about 800 crores. Even after adjusting for the one-time expense related to metformin and the other products. And given that we would have these marketing expenses on the domestic formulation, on this inorganic part, as well as ramp up of the diagnostic activities. So how do we see on an absolute basis these other expenses, reducing by what % going forward?
It's actually several line items that have been combined in there. So you're right about the fact that there is diagnostics and other expenses also. So to the extent you need to really look at on each item. We could take that offline for sure, but we are working on a number of initiatives to address that.
Sure, sir. But any ballpark number, like by what % you intend to reduce this?
It would really all feature ultimately in the EBITDA improvement, right? So irrespective of what is the absolute number itself, we obviously taken that and saying that the EBITDA improvement will take place in the time period that we indicated.
All right, so that's it for me. Thanks a lot.
Thank you. We'll take the last question from Mr. Vishal Manchanda. Vishal, if you can unmute right now.
Yeah, thanks. Am I audible now?
Yes.
So, sir, just wanted to check whether levothyroxine is still an important product for you in the US.
It is.
Okay.
We have 17-18% share of the market.
Okay. And it's like a meaningful percentage of your overall sales in the US.
Our largest product is albuterol. It's smaller than it was in the past because of the competition we have seen in the last 12 to 18 months, but still a material volume product.
Got it. Thank you.
Thank you. That was the last question. I now hand the conference over to management for the closing comments.
Well, thank you everyone for your active participation. Very useful. Some of the questions that you raised, and look forward to seeing you in the next quarter. Thank you once again, and take care of yourselves and your families. Thank you.
Thank you, sir. On behalf of Lupin Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines and exit the webinar.